Okay, so I'm Bob Hunt with the Federal Reserve Bank of Philadelphia, and I am the Associate Director of the Consumer Finance Institute, which represents 70 economists and senior analysts at the Philadelphia Fed that conduct research on all aspects of consumer credit and payments. And one of the reasons why the Philadelphia Fed is a co-organizer of this conference is the expertise of Julapa Jagtiani on fintech. She's published a number of very influential papers in that area, organized the conference last year, and my thoughts go out to her now. My job is to try to synthesize everything that we talked about today, and I'm probably going to sort of work a little bit backwards through the presentations that we had. I thought we might start with Mike's thoughts. First of all, he described this as a currency. It's a store of value, it's a medium of exchange, and it's a unit of account. It's also the Information Security Department in the Federal Reserve System, and I'm underneath that. So, as I was listening to Mike, I was wondering, if he designed my furnace, what would it look like, how would it work, and how would I know what to do with it? Hopefully he doesn't design furnaces for you. I want to go back to some discussion about the regulatory challenges that virtual currencies and Bitcoin bring, not just to central banks, but to state and local governments and other federal agencies, because they bring up some long-standing issues in some different ways, but issues that have been around for a long time, that are very hard, especially in the United States as opposed to other countries, to wrestle with, because we have so many layers of government, and then even at the federal level, we have segmented the way in which we do the regulation of financial services into easily a dozen different agencies, and that design made a heck of a lot of sense when we did this in the 30s and the 40s and the 50s, but it becomes very hard to think about it in the sort of the modern design of the financial system, and maybe even the emerging financial system. So, for example, we had a fascinating talk from our keynote speaker from Norway, discussing the role of central bank currencies and the ability to do monetary policy. So as long as you have a unit of account that is under control of the central bank, you can conduct monetary policy even if you have no paper cash in the system. As Bill Nelson said, if the unit account is not under control of the central bank, then you do not have independent control of monetary policy. You are dependent on some other organization. And that's an interesting insight. One of the other areas of work that the Philadelphia Fed has done is in virtual currencies, at least on the theory of virtual currencies, not on the practice or the empirics of it. So we have an economist, Daniel Sanchez, who has done work with a professor at the University of Pennsylvania, and he points out that having an economy in which there are multiple private currencies, which is not a new thing, because we had private currencies in the United States for the majority of the history of the country, but we did not have a central bank that was conducting monetary policy at the time. But if we had competing private currencies, this would complicate the monetary policy of a central bank. Now, according to the modeling that these economists have done, the central bank can commit to a specific type of policy that would essentially drive the private currencies out of the market, and then it can retain its control over monetary policy and the money supply. And that's a good thing. I'm going to jump over to William's presentation from the first panel. You remember he wrote down a fundamental pricing equation, if you can remember that, and he had an integral. And the top of the integral was in infinity. That is quite possible that the expected appreciation of currency could become infinite. but he had a fixed lower bound of the expected appreciation of the currency. Well, in fact, in another paper that was done at the Philadelphia Fed, in equilibrium, there is no guarantee that there's a lower bound to the value of that currency. And if that's true, then a private virtual currency is not sustainable in all states of the world. There are states of the world in which you will not find a party that is willing to sell or a party that's willing to buy. And if everyone knows that, the fundamental value of the currency goes to zero. And once again, this poses a question that Bill actually raised. So when we have a panic in assets, leveraged assets that are denominated in a virtual currency, is the central bank going to act as a lender of last resort and essentially support the value of a privately issued virtual currency? And the research done at the Philadelphia Fed says, if you have to do that, and it may be inevitable that you have to do that. By the way, did I do my disclaimer? These are all my views. If it's inevitable that you have to do that, then you might as well issue a central bank currency. Because you don't have the moral hazard problem that's implicit in the type of issue that Bill was describing. Bill's discussion, I think, was absolutely excellent. Bill made another important point, which is a lot more general than just virtual currencies, which is since the financial crisis, we now understand that there has to be an entity that is going to have prudential supervision of leveraged organizations that engage in liquidity transformation. That is, take cash today and create long-lived illiquid assets for tomorrow. And that includes shadow banking. And shadow banking was part of the financial crisis that we had. Dodd-Frank was an exercise in doing this. It vested most of those powers in the Federal Reserve, but also in FSOC, right? And so when you think about the financial crisis, the analog was the money market account. So this was fortunately denominated in dollars. It did not implicitly have deposit insurance, explicitly I should say, and there was a certain point in which the returns on money market accounts were so low that they were going to break the buck, and that was going to create a panic in a market of several $trillion, and the underlying assets behind that were illiquid. It became very close, and then there was this question about whether the FDIC and the Fed were going to have to rescue the money market accounts. And if you compound that with the fact that this could be denominated in another currency, then you can think about the financial stability implications of that. So there's no way around the fact that if the shadow banking sector becomes significantly involved in assets that are denominated in a private virtual currency, then it's going to have a vested interest in understanding who owns the implicit asset and liability there, and as well, what is the leverage, and eventually there will be regulations over the level of that leverage. I want to turn to Yaya's discussion for a minute. He was really fascinating, and at one point he was almost suggesting that the first use case of Bitcoin is money laundering. And that's almost like thinking back to when the internet was commercialized. It was essentially commercialized on cat videos and pornography, right? And eventually we figured out other ways of doing things on the internet that added value. And this goes back to my time. I started my career, like Nolan, working for the legislature. In this case, it was the U.S. Congress. This was back around 1995, and I worked for an organization that issued one of the first studies of digital currencies. At that time, it was something called Digicoin or Digicash, and this was the idea of actually having the store of value in your possession, whether it was on your computer or on a card. And the use case at that time was micropayments, which was discussed today, and payments on the internet, because at that point, no one was convinced that people would use credit cards for internet payments. And so the feeling was that there was not a payment instrument that might work for e-commerce. Well, obviously the credit card took over. Consumers were comfortable using their credit cards. And the reason for that is because networks gave a very strong guarantee of protection against fraudulent transactions to the consumer. And the cost of providing that guarantee against fraud was borne by the internet merchants. And what we know from the data is that the amount of fraud on e-commerce is multiples of the amount of fraud at the point of sale. And a lot of people complain about that, but the fact is that the ecosystem can live with that level of fraud, and the share of all transactions or all purchases that are conducted in the U.S. economy via e-commerce rises every year. So an existing payment network figured out how to solve that problem with a combination of providing insurance to the consumer and then improving its fraud screens for internet purchases. Nolan's conversation, he alluded to a number of the other use cases that you can think about for the blockchain. And at one point he was alluding to the role in compliance. And I want to give you an example that banks have to deal with today. So when you and I apply for a credit card and we're given one, we are given a contract. And it tells us what the terms and conditions of the contract are. If you ever look at one of these, you'll notice one thing: there's no date on it. And the other thing is the bank reserves the right to change the contract at any time. And if you've had the card long enough, they've done that. So the question is, what contract are you bound to? And that becomes important if you have a dispute with the bank, or if you default and it goes into collections. Because if you litigate that, you need to know what was the contract. You also would like to know what was the actual balance of the debt at the time that it was defaulted on, so that when the collection firm comes after you, this is the right amount of debt that you should repay. None of that information exists in a very easy form in the banking system right now. But a blockchain would be a very easy way of implementing a digital signature along with a irrevocable version of the contract you agreed to that can be preserved and transmitted if necessary for the purposes of litigation at practically no cost. And then in the collection sphere, which affects easily 10 to 15 million Americans every year, the court has a record of the contract you signed, how much you owed, whether in the past you have disputed this, I didn't take out this debt, or this is the wrong balance. That record is transferred so that the churning that goes on in the debt collection market could be eliminated right here. And this sounds like picayune, but that would eliminate a major hassle. It's the leading source of complaints in this country is about debt collectors. So that's just one example of where technology could take a lot of cost and friction out of consumer finance. The director for the Norges Bank asked about a fallback. What is the fallback if we go entirely to electronics? In the case that, for example, a state decides to attack the payment system. And it turns out that Europe is better positioned for this than, I would say, the United States. And the answer would be the equivalent of a prepaid card in which the store of value is on the card. It is not on a network or a server somewhere else. And you use the EMV terminals that are used in Europe. They're not the same type of terminals that we have in the United States. Those EMV terminals can essentially conduct the record keeping remotely on the terminal so that you can continue to transact even if the servers are down. Now, it's possible that a state could attack every one of those terminals, but it would be a lot harder to get all of the terminals as opposed to a successful attack against a server. So that's an electronic fallback that the payment system could certainly adopt. I'm going to jump back to William for a moment. I'm sorry I'm jumping all over, but I'm trying to follow in Mike's path. William showed something else. This was his second paper. He was talking about this role that people are pooling in order to do the blockchain transactions. And as the pools get larger, two things happen. The markup on what they're doing rises, and they don't grow as rapidly, which is really standard economics. That's one of the arguments that people made early on about virtual coins and the blockchain. We want to get all the intermediaries out. We feel that the intermediaries are essentially gouging in payment transactions. That's certainly the accusation for card networks. And here we have in the blockchain this exact same phenomenon going on. So it is not the case that even with distributed clearing and settlement that you get around the market structure and antitrust issues that are ubiquitous in payments. They're just manifested in different ways. Probably not in ways we measure as well, but they're still there. And this goes to the point that, because of very strong network effects in payments, it is almost inevitable that you have, at some point, a concentration. And then when you have that concentration, you can have market power. And then the question is there a need for a regulatory intervention? And what would be the mechanism that you would use? And more importantly, do you have the information such that when you intervene, you don't do more harm than good? Because most of these regulatory interventions require a high level of information so that you don't make the market less efficient than if you left it alone. Let's just see here. I think those are all of the comments that I want to make. How much time do we have?
I'll give it another 5 minutes.
All right, so we have 5 minutes. This is an opportunity for anyone in the audience to voice their own opinions about things. I'm not sure you want to ask me questions because I doubt I can answer them. But you're welcome to voice your own opinions about what we've talked about today. Sure.
Well, I'd like to raise an issue that has been discussed relatively little, and that is, suppose there is a world private currency, and it takes over. Then that means that national governments will not be able to conduct monetary policy, which is something that is useful because, the world in which I don't believe, I think nobody believes that, that the nation state and the different fiscal authorities that we observe today in the world are going to disappear.
So the first part of that was a world currency, right?
Yeah.
Okay. So, I mean, fundamentally, you have to displace the core reserve currencies of the world before that can even happen. So who's going to trust a world currency, for example, over a currency that is implicitly backed by the wealth and income, the present and future wealth and income of the United States or Europe? Because that's really what's backing the euro and the dollar. We're a long way from having a trust mechanism at a worldwide level that's going to provide more confidence in what truly backs these fiat currencies than the economies of Europe and the United States, and eventually China. Not yet, but eventually. And so, really, the issue for countries that are not a reserve currency, they do have this possibility. And I think that you think about Venezuela, for example. These are economies that can essentially, it's not dollarized, what should I call it, Bitcoinized, because there's no faith in the domestic currency, and people know that there will be more opportunities to evade capital controls if they can go to a form of a virtual currency and move their resources out of the country. That's a concern for any country for which its own people does not trust their domestic monetary authority. And there's certainly countries like that, but they're not very wealthy countries. Yeah.
I just have a question kind of following up on that. Where countries don't have, citizens of the country might not have faith in their currency. Previously in history, there wasn't really a good alternative to your state's currency. I'm curious if anyone has an opinion on, like, if the fact that you could say in Venezuela, go to Bitcoin, if that could destabilize or dictatorships that are failing, and that allow them to fail faster and an alternative would maybe take its place.
Well, I think this is a good example of old things are new again. It's the equivalent of saying, if I can more easily evade capital controls and capital flees from the economy, does that bring down the government faster? Historically, that's true. So if the outcome of things like virtual currencies, but also there's a lot of other things going on right now in the world to facilitate cross-border payments, to make them more accessible to average people, lower the costs of doing them, and make them more ubiquitous. Depending on the country we're talking about, that may make it easier to move funds across the border, and if you have a flight to quality, that might affect those governments. That's true. But that's why they have capital controls in the first place. Bill, you wanted to raise.
I just want to follow up on
Yeah.
that, and
Yeah.
it's close to what I said in my remarks, but in preparing for these remarks, I did reach out and speak to some central bankers from countries that did dollarize, and their universal view was, in an environment where people have lost faith in the currency, they're going to want something that they can have faith in.
Right.
And it's not going to be some anonymous platform currency where they don't understand what's going on. Although I think your point about capital controls is excellent. That adds a dimension that's different. But
I think maybe I can add something to that. What you said that basically under the existing system, the reason that the dollar, let's say, and the distance also the euro are basically key currencies, mainly the dollar, is because it is backed by the stability and the rule of law and the GDP of the United States. Now, those guys, those countries where you have inflation and they don't have enough discipline to have a stable currency or something like that, it's very likely that if they really desire to have price stability, they are going to go to a key currency like the dollar or the euro, something like that.
Or they could put in place a strong independent central bank.
That's right, that's right.
Assuming they have the social will to do it.
Yeah.
Yes. Yeah.
What about some of the new offerings are being backed by gold to kind of, some of the cryptocurrencies are currently being offered with
Yeah, so
backed
that's like a hybrid, right?
Mhm.
And I'm not sure I've seen these people now. ICOs are kind of like that too. As I was listening to one of the presentations earlier, to me that sounded like you were partly collateralizing the value of the coin on a future claim to the capacity of the company. And then the value actually was an expectation about what that future capacity would be worth. And I bet there's going to be more and more and more hybrids of these. So we also heard a presentation where somebody tried to decompose Bitcoin into three sources of value: speculative, store of value, and transactional. Right. So even in Bitcoin, there are three use cases that apparently have a market value to them. And all that gold would do is put another component in the store of value. And if I heard Christine's remarks earlier correctly, that the interesting thing about Bitcoin is it's clearly correlated with other virtual currencies, but it's not very well correlated with any other asset that's out there. So maybe, which means it's very hard to hedge. So maybe one way of solving the hedging problem is by embedding it with a commodity we already know how to hedge.
No, but the problem is, from FDIC standpoint, we usually know about the collapse of some wallet or exchange within 10-15 minutes, because our hotline starts to blow up, people asking for deposit insurance for these wallets.
Right.
So they think it's money, and they think it's FDIC insured, and if you go to Coinbase, it says it's FDIC insured,
Right.
up to
Well, and
the pass-through insurance.
And they might think that this is covered by the Electronic Funds Transfer Act, but it's not. So all the guarantees that we usually provide around electronic payments don't apply here. Usually if if you lose cash, paper cash, it's either because you were robbed or somebody broke into your house. Right now, we're talking about a total different technology for stealing from you, and yet it's, it's still buyer beware in terms of, whoever has the cash, it's theirs in the long run. This goes back to this discussion about Bitcoin as a push transaction. That's true, but there are a lot of other ways of doing push transactions with the existing payment systems, and in fact, you can use the equivalent of a debit or ATM network to do push transactions, and all of the new faster payments, including Bill's design, is push. So if we think push is more secure and has other advantages, we don't need Bitcoin to do that. We can do that right now.
But can I also flash another issue? So it's immediate, it's not hypothetical. If cryptocurrency, crypto assets, or whatever they are, in whatever legal form they are, start to show up on the balance sheets of banks, which are FDIC insurance and which go into recovery and resolution, we immediately face with the issue how we get access to those vested protected assets. And so far, I don't see any solution other than take the CEO chain to the chain, start to torture him. Otherwise, how we as a resolution authority actually can safeguard assets of a financial institution?
I think Bill touched on this in his remarks. If it's literally on the balance sheet of the bank, then the supervisory community is going to have to develop standards for that. It's similar in the sense of, in the FDIC's regulations, being able to identify the true owner of a deposit account, right? It's the same issue. And then the other part, which is more tricky, is, okay, I'm not directly acquiring these assets, but I'm lending to companies that are investing in these assets, so I'm indirectly exposed. And the supervisors need to have an ability to view that. And so there's an accounting aspect here that becomes important anytime you are directly or indirectly using leveraged institutions to finance these things.
If it's immutable and if money went out of the bank, what does it mean?
I didn't get the last one.
If it's an immutable blockchain or whatever ledger you're using, and if the money went out before you managed to establish the ownership, what happens?
So you're saying this would be like an instantaneous run? There have been some central bankers who have talked about the fact that the thing about a digital currency is that it would facilitate the loss of liquidity in banks much more easily than the usual ways in which you might wire money out or you might just hit the ATM, but that there's frictions to that. And they have talked about that as a concern. I don't know, Bill, if you have a comment about that.
No, that was part of Mark Carney's remarks about a month ago.
Yeah, exactly.
It's actually a concern that came up in the Fed's discussion of the reverse repurchase facility as part of their exit tools, in that it does offer a way to shift your funds very quickly out of the banking system into a completely safe place, and that facilitates sort of flights to safety instead of there being a price mechanism that cushions it. In other words, normally with a flight to safety, you have to give up yield in order to get the safe asset.
Mhm.
But if the central bank is offering an infinitely flexible, totally safe asset,
Right.
then people can flee risky assets immediately and without incurring anything like the same costs. So it does have some financial stability concerns there as well.
But regarding that, the central bank can offset that by basically paying a negative interest for the money that goes to the central bank. In other words,
You're
zero
right.
lower bound, because we were problem with the last crisis,
Yeah.
basically disappears in the process of the digital currency.
Yeah.
So, Switzerland, for example, now has minus 0.7 interest rate, and this is considered to be the very minimum that one could go. But if the central bank issues a digital currency, there is no downward limit.
Yes, but the converse of that is, in a financial crisis, people may not be very interest rate elastic. You may have to have a huge tax in order to keep money in the banking system. And I don't know that we have a lot of theory or empirics to be able to tell us how the economy functions when that happens. So it's one thing if it's -2, What if it's minus 20? Right?
Well, I mean, if the alternative is to have a meltdown of the financial system.
Yeah, I agree. I mean, you're solving a problem that's in front of you that you're aware of, and then you're implementing a solution we've never done before. And we don't know all of the implications of that. And God help us if we never do.
I think with respect to crypto, one way of mitigating that, it would not solve it, would be to build KYC into some of it. But then that has other issues with respect to current users.
Right. Yeah, I don't think blockchain and KYC are incompatible.
Exactly, right.
Yeah.
Yeah. I think we need to build a system where some of that is available. At least build a strong crypto that has both the DLT and KYC.
Okay. All right.
Thank you. And just, this is the conclusion on behalf of Julapa, Michael, and myself. Thank you for attending the conference. Just for your information, all the material, the slides will be available on the GIC's website in Philadelphia, Philly Fed, as well as at the Law College of Business. Give us a week or so. Thank you very much for attending the conference. Appreciate it.